Hi guys, welcome to my channel. Recently, I've been receiving many comments regarding the content I published. Thank you so much guys for following me. In these comments, I've analyzed one thing, and that is everyone are interested in investing in the stock market, but they are unsure about how to start and where to begin. So in this video, I'll provide a comprehensive detail regarding how to invest in the stock market, and I'll provide content on how to differentiate the stocks. So without further ado, let's dive into it. Before you start investing in the stock market, it is very important to open a brokerage account. Now, what does a brokerage account mean? A brokerage account is nothing but an arrangement between a licensed broker and an investor, wherein the investor puts in the money and the licensed broker places the trade for the investor. This broker acts as an intermediary between the investor and the stock market. Even though the broker places these buying or selling orders, the asset completely belongs to the investor. Once you open this brokerage account, then the next important thing is to fund your account. Now, this funding is very important and it depends on your ability to place your bets on the market. Third thing is invest based on your interest. Now, this completely depends on your risk to reward ratio and the amount of risk you're willing to take based on your trades. Now, the first thing is where can you open a brokerage account? There are many brokerages in the market, so you can choose anything which suits you and which is comfortable for you. These are some of the brokerages that are present within the market. These brokerages also provide you with commission free services wherein you can buy and sell a stock without providing a commission to the brokerage. Selecting a brokerage account is as critical as buying a stock. It is very important because if the commission is more for a brokerage account, it depletes your money in terms of commission rather than gaining profits. Now, once you open a brokerage account, you can invest in the stock market. Now, there are two types of investing. One is active, another is passive. Before we go in depth into the subject of investing, we need to first understand what active and passive investing are. Active investing, as its name implies, takes a hands on approach and requires that someone act in the role of a portfolio manager. The goal of active money management is to beat the stock market's average returns and take full advantage of short term price fluctuations. It involves a much deeper analysis and the expertise to know when to pivot into or out of a particular stock, bond, or any asset. A portfolio manager usually oversees a team of analysts who look at the qualitative and quantitative factors. Active investing requires confidence that whoever is investing the portfolio will exactly know the right time to buy or sell. Successful active investment management requires being right more often than wrong. Coming to passive investing, if you are a passive investor, you need to invest for the long haul. Passive investors limit the amount of buying and selling within their portfolio, making this a very cost effective way to invest. The strategy requires a buy and hold mentality. That means resisting the temptation to react or anticipate the stock market's every next move. The prime example of a passive approach is to buy an index fund that follows one of the major indices like S&P 500 or Dow Jones Industrial Average. Whenever these indices switch up their constituents, the index fund that follows them automatically switch up their holdings by selling the stock that's leaving and buying the stock that's part of the index. This is why it's such a big deal when a company becomes big enough to be included in one of the major indices. It guarantees that the stock will become a core holding in thousands of major funds. When you own tiny piece of thousands of stocks, you earn your returns simply by participating in the upward trajectory of corporate profits over time via the overall stock market. Successful passive investors keep their eye on the price and ignore short-term setbacks, even sharp downturns. So active and passive investing depends upon your mindset. If you are willing to risk your money and if you have the ability to beat the stock market's average, then you are an active investor. But if you want to play it safe and create wealth for the long term, then the recommended trend for you is passive investing. Active investing also means investing it in a particular stock. Say you invest in Apple or Tesla or Facebook or any of the stocks separately. Now this is active investing. But while coming to passive investing, it means you are buying an index fund. The best index fund in the market is the SPDR, which follows the S&P 500 index, wherein the S&P 500 index contains the biggest 500 companies present in the United States. Once we understand the types of investing, we need to then understand what are the types of stocks. There are two types: value stocks and growth stocks. Now, what is a growth stock and what is a value stock? The concept of growth stock versus one that is considered to be undervalued generally comes from the fundamental stock analysis. Growth stocks are considered by analysts to have the potential to outperform either the overall market or else a specific subsegment of them for a period of time. Growth stocks can be found in small, mid, and large cap sectors and can only retain this status until analysts feel that they have achieved their potential. Growth companies are considered to have good chance for considerable expansion over the next few years, either because of the product or line of products that are expected to sell well, or because they appear to run better than many of their competitors and thus predict to gain an edge on them in their market. Value stocks are usually large, more well-established companies that are trading below the price the analysts feel the stock is worth, depending upon the financial ratio or the benchmark that is being compared to. For example, the book value of a company's stock may be at $25 a share based on the number of shares outstanding divided by the company's capitalization. Therefore, if it is trading for $20 a share at the moment, then many analysts would consider this to be a good value play. Stocks can become undervalued for many reasons. In some cases, public perception will push the price down, such as if a major figure in the company is caught in a personal scandal or a company is caught doing something unethical. But if the company's financials are still relatively solid, then value seekers may see this as an ideal entry point because they figure that the public will soon forget about whatever happened and the price will rise to where it should be. Value stocks will typically trade at a discount to either the price to earnings, book value, or cash flow ratios. So, value investing is a kind of an orthodox trading, and growth investing is a way to gain more money in a short period of time. Value stocks are orthodox companies which have been established long time ago. These are some of the value stocks that are present within the market and are perfect for investing. Growth stocks provide a rush in the stock price, and these companies have been growing rapidly since the past 1 year. Investing is an ocean. It cannot be narrowed down to a single point. These are just the main basics of investing and the kind of stocks that are present in the market. If you want more information regarding investing, please comment, and if you like this video, hit the thumbs up and please subscribe to my channel.